Hello, and thank you to everyone who's joined so far. I'm just going to give it 1 minute to allow people to come through from the lobby area, and then we'll begin. Okay, well, hello everyone, and welcome to today's masterclass. My name's Louisa Gaynor, and I'm a senior client advisor here at Netwealth. And as you can see today, I'm joined by Lily Ball, who's one of our associate client advisors and who sits with me on the advisory team. And we're going to be looking at the importance of navigating investment fees, really with the ultimate purpose of delivering to you those better take-home returns. So Lily's going to start us off by providing some background as to the type of investment fees that we should expect to see when looking at a cost and charges report and what these actually really mean for our investments. She'll also address the importance of being mindful of those costs and understanding the impact of them, even the attritional ones, and what they have on the value of your investments over time. We'll then do a bit of a turn to focus on the net wealth approach and how we at Net Wealth control client costs, because this really is something that is at the forefront of our minds and the heart of our philosophy as a firm. So during the session, we'll provide a demonstration of how we achieve this through the use of our technology, which not only enables us to drive economies of scale and keep those costs down, but also really to enhance our service by providing clients with a much greater degree of flexibility around their plans, transparency and efficiency when it comes to understanding and managing their investments. We've had a number of questions submitted ahead of the session, so thank you very much for those who've done so. We've hopefully tried to incorporate these in our responses, so they should be covered in today's content, but we will also leave some time at the end of the session to answer any questions that come through as we go along. So please feel free to submit these in the question or the chat blocks that you can hopefully see on the webinar application. And we are also offering one-to-one follow-up sessions. So these are usually a really good opportunity for you to discuss your specific circumstances with an advisor and perhaps also review your existing investment setup and the associated cost of these in much more detail. So please feel free to book into those if you haven't already done so. I believe that a link will be circulated along with the recording of this session shortly afterwards. So we look forward to seeing hopefully as many of you as possible then. But for now, I'm going to pass over to Lily, who's going to start today's session.
Thanks, Louisa. So to get started, let's dive straight into the different types of investment fees. Now, I appreciate this slide feels a little heavy on information, but we will go through each one by one as people are often surprised by the different shape and form investment fees come in and perhaps don't have the full transparency on exactly what they are and the level you're being charged. So if you are unsure of what you may currently be getting charged for these different fees, then do speak to your current providers. It is a regulatory requirement for them to let you know exactly what you're paying, both in percentage terms and pound and pence. So do ask, and of course, we'll run through what Netwealth charges in this respect a bit later for you to compare. But to start, let's look at the annual investment management fees. So this is levied for discretionary investment management, where someone's managing your investments for you. And this is typically charged as a percentage of the assets under management. So it can range from sort of 0.5% to sometimes 1.5% or more. Many people are unaware of how much they're paying their investment manager, since this charge typically is taken out of the value of your assets rather than being billed directly. So if it is at the top end of that range, it's extremely impactful on your overall net returns. And this is why it's so important to understand what's being taken out of your pot in annual fees. And if you aren't sure, then ask companies such as Netwealth to help you work through the detail. Next, we have regulated advice fees. Now, this is also typically charged as a percentage of the assets under management or the assets that are under ongoing advice. We'll touch more later on what advice fees can cover and when it may make sense to pay these fees for financial planning. But typically, regulated advice can be offered and charged either on a one-off basis or ongoing. If there is a specific piece of advice required on retirement, inheritance planning, and things like that, then it can be more cost effective to take the one-off advice hit rather than paying ongoing for a service you perhaps don't need or don't need yet. So be aware of the advice fee options at your current provider and be sure to compare them to the wider peer group to be sure you're getting a fair competitive price. It's also worth checking what your advice fee consists of and whether it's suitable for you. You certainly shouldn't be paying charge steep fees merely for sort of contributing to an ISA every year, which often can be the extent of people's plans. The fees for financial advice may add another 0.35% to 0.75% to the total that's being charged on your portfolio. So it's definitely another one to be aware of. VAT is one most people wouldn't consider, but it's often not embedded into the price you're quoted. So do check whether VAT is included in your quoted investment and advice fees. And if not, then you may need to apply an extra 20% to the figure you're given. Moving on to custody and platform charges. So custody charges are the fee for holding your investments, dealing with any corporate actions, collecting dividends and interest if that's applicable, as well as any other administration on your account. This is also typically charged as a percentage on the assets and sometimes can be included within the quoted investment management charge, although that's not often the case for DIY platforms. So DIY investors should check their fee for that. Transaction charges when you buy and sell can be commission based or fixed fee for the administration, which could vary between sort of £10 and £50 per trade. Some providers may not charge extra for the amount of transactions you're doing, so do check that out if you're not aware, and particularly perhaps be aware of FX charges. These can particularly sting and are typically not the most transparent, probably because they're not the most common, but also one to be aware of. And finally, underlying investment fees. So actively managed funds, exchange traded funds or ETFs, and investment trusts all have their own fees. And the choice of underlying instruments can impact how big or small this underlying investment fee charge is. And I'll touch on that more on the next slide. But underlying fund charges can have a big impact on your overall net returns and typically not that easy to find out as they aren't taken from your portfolio and instead are factored into the daily price. So hopefully from this slide, you've gathered the many types and forms investment charges can come in, some more forthcoming and obvious than others, but all important to be aware of because all of them eat into your take-home return at the end of the day. There may also be some more specific fees levied on pension accounts that, of course, you should also be aware of. Those fees levied for income drawdown or an annuity purchase charge, for example. But these are relatively small charges compared to the ones listed above. All in all, we regularly see investors being charged total annual fees of between sort of 1.8% all the way up to 3%. This type of fee load can be hugely damaging to long-term financial outcomes, and that's why we're running this session today to help raise awareness about the impact of fees and to hopefully provide some insight into our service that is lower cost without compromising on any requirements that clients may have. For now, as I mentioned before, let's take a closer look at underlying fund costs. So as I said on the previous slide, these are an important charge and can often rack up quite substantially if the portfolio largely consists of actively managed funds. These costs can be significantly lower if your portfolio manager is using index tracking funds, otherwise known as passive funds, since this approach generally helps keep costs down compared to managers who are sort of stock picking and selecting individual stocks or actively managed funds to make up a portfolio. Buying and selling investments regularly can also be expensive, and this can be heightened when managers are rotating the makeup of their funds as and when their conviction changes. But at Netwealth, our portfolio management team actively run our 7 different risk level portfolios. But the way we choose to implement that active investment strategy is through predominantly passive instruments or ETFs. Despite having the freedom to invest in the entire stock and fund universe, when you look at the data, such as that presented on this slide, once you account for fees, passive strategies tend to outperform active strategies over different time horizons and different geographies, with the main outliers you can see there on a shorter term basis only in certain areas such as the US and Europe. The data and the lower costs that we then pass on to clients as a result of our passive implementation strategy are the main reasons why our team opt for these investment instruments. And it's worth checking if you're DIY or use a discretionary portfolio manager, what strategy they follow and the costs associated with the underlying funds. As you can see by this slide here, typically with the larger fees on active funds, you aren't getting the better net performance. We actually had a question in before the session today on this, asking, is it true that only about 4% of managed funds will outperform a tracker? And if so, why bother with managed funds? And are fees a factor in this outperformance or underperformance rather? And so hopefully this slide helps to answer that question, as it's performance after fees that is the key. And as the question correctly points out, and as the data shows here, actively managed funds rarely outperform passive funds or ETFs over different time horizons and different geographies. So do be sure to check your investment strategy and the fees that are associated with it. We've run through the different types of fees. Now I briefly want to touch on the costs associated with Netwealth's investment management service so that you have a comparison point for your own figures if you use another provider. So as Louisa mentioned, we sort of place transparency on fees at a very high importance, and so are always happy to compare and contrast against current providers. So in Netwealth, we charge an all-in management fee that includes investment management, custody and administration, tax reporting and VAT, and we don't have any platform costs. So that top line Netwealth management fee that you can see there includes all that I've just listed and varies depending on the amount invested. So you can see from £50,000, which is our investment account size minimum, to £250,000, you're charged 0.75%. And from £250,000 to 1 million, it falls to 0.6 and so on. But it's worth highlighting that these fee bands are cliff pricing. And by that, I mean that if you invest £251,000 with Netwealth, that entire amount is charged at the 0.6% as you've reached that fee threshold and not just the amount over that £250,000 fee threshold. Below the Netwealth management fee, you can see there, you can see our estimated underlying fund costs and estimated costs of trading that we estimate totaling together sort of around 0.3%. This may vary slightly depending on the risk level you're invested in, if one has more investments in than the other, but our team do continual due diligence on keeping these as low as possible, both with existing investments that we hold, but also when deciding on whether to introduce new investments to the portfolios. So those bold numbers at the bottom are your total annual costs of investing for investment management, VAT, custody and administration charges, transaction and underlying fund costs and Netwealth. The only numbers not included there are on regulated advice, but Louisa will cover this and the associated costs a bit later in the session today. I've included here our most recent performance slides across our 7 different risk levels to the end of May, as the focus today is all about fees, so showing our net of fee performance here. You can see risk levels 1 to 7 there in the different colours, the dark blue being our highest risk level 7, at the top with 89.7% total return since inception, and our inception's May 2016, so that's 8 years worth of performance data, and risk level 1 being our lowest risk at the bottom in the grey. Now, what's also important to look at on this slide is the annualized return figure on the far right-hand side for each risk level. So annualized return is a measure of how much an investment has increased on average each year since our inception in 2016. So you can see for our highest risk portfolio, risk level 7, that annualized return is over 8% net of fees. And for our balanced portfolio, risk level 4, you can see just shy of 5% annualized returns. If you'd like to have a look at our performance packs in more detail or in your own time, then please do email advice@netwealth.com. We'd be happy to share this information with you. And of course, if you book the one-to-one portfolio review session offered after the webinar today, we can run through any performance related questions or comparisons versus current providers on both performance and fees, as it's the net of fees performance that should be the focus. Now on this next slide, I'm showing the same information on our 7 different risk levels and their performance since inception as I did on the previous slide, but here we're showing our performance relative to the ARC benchmark. and this is important for two reasons. Firstly, to highlight the team's positioning and how this helps performance. But in respect of this session today, to highlight that positive tailwind that our portfolios receive from our lower fees compared to the industry standard, as the figures here, same in the previous slide, are shown net of all charges associated with the underlying investments and the 0.45% net wealth management fee. The ARC benchmarks that you can see here in the light grey that we compare to is Asset Risk Consultants, and they're a third party who amalgamate the performance data of over 100 wealth managers in the UK to produce a peer group average for a given level of risk. So ARC includes data from providers such as Citi, St James's Place, Vanguard, many more. So you can see our highest risk level portfolio, risk level 7 on the far right hand side, compares with ARC equity risk and so on for the different risk tolerances. And we use this as a benchmark as it provides an insight into what a private client in the UK wealth management space can expect to receive for a given level of risk. And as you can see from our portfolio inception in 2016, May 2016, our portfolios are outperforming the benchmarks shown in the grey across all risk levels. And this, in part, is due to the lower fees providing that positive tailwind for performance. Now, it's all very well sort of seeing the figures and numbers written down and comparing that, but sometimes it can then be hard to visualize just how much of an impact 0.5% or 1% fee difference can actually make. So in this next section here, I'm going to focus on that and run through a few case studies to show just how impactful fees can be and how this can affect your investment returns over time. So on this slide here, we show how low fees can make a big difference. So on this graph, we have £250,000 in a portfolio invested with Netwealth in the dark blue line, or £250,000 invested with a traditional wealth manager in the grey. Now, for the purpose of this illustration, we've controlled for performance and are assuming that both portfolios are invested exactly the same and both growing with an annual return of around 5% per year. So we're controlling for performance and seeing the difference between those two lines down to the impact of fees and fees alone. So for investment management at Netwealth on a £250,000 portfolio, you qualify for the 0.6% net wealth management fee. And we've also added the 0.3% underlying fund and trading costs too to get you to that total all-in fee of 0.9%. Now for the other portfolio in the grey, we've assumed a 1.65% investment management fee, trading and underlying fund costs. We got this information on the traditional wealth manager fee from research by Numis and Citywire. As you can see, the impact of this 0.75% fee difference, which may feel negligible versus the aggravation and admin associated with moving your funds to a different lower cost provider, can have a profound impact on your portfolio when that difference is compounded over time. So by the end of 20 years, you can see the difference between the two lines is stark, and by being with a different provider, achieving the exact same service, exact same portfolio returns, but just at a lower cost, you could save over £75,000 in fees alone. And that's not a negligible difference when in pounds and pence as compared to how 0.75% fee difference may feel or sound. So that £75,000 difference in fee savings in any portfolio is welcomed at any stage of life, but specifically thinking about retirement pots, that equates to the difference between a higher level of income attainable throughout your hard-earned retirement or your retirement income lasting for longer. And that's something we're going to spend a little bit more time on now with some modelling on the next slide. So this case study is specifically focusing on the impact fees can have on a retirement pot. So here we're looking at an individual 60 years old looking to draw an income from their investment portfolios. Their portfolios total £1 million, together with the main bulk of that in the pension account, as is the case for most people. And they're looking to draw a retirement income of £2,750 a month, net of tax, from their portfolios starting now. And you can see here from this projection, with inflation applied, by the time the client reaches age 95, they've met their objective and achieved the desired income from their portfolios, and they actually have over £365,000 remaining at age 95, all in their pension if we assume the average scenario. And it being in the pension at the end is beneficial from a financial planning perspective, as your pension falls outside of your estate for inheritance tax purposes. And so this client has achieved an objective of their investment portfolios providing an income for their retirement, and they've also been able to pass on a nest egg to the next generation with the funds left in their pension at age 95 that is then outside of their estate for inheritance tax purposes. Now, if we look at the exact same inputs to the projection on this slide, the client's the same age, their investment strategy and performance is the exact same. They're starting with £1 million in their portfolios and still looking to draw that same amount, 2,750 a month net. The only difference between these two projections is a 1% difference in fees, which we commonly see at Netwealth. So if we look at the average outcome in this scenario, you can see that the funds run out sooner in 2056 due to the compounding impact higher fees have on your portfolio and the drastic impact this can then have over time. Now, this 1% fee difference means 5 years less retirement income. And this might not feel too important, as the previous slide modelled all the way to age 95, which is something we do at Netwealth for prudence. So funds running out at age 90 may not feel like an issue for some people, but that fee saving instead could translate to higher retirement income levels. So if you pay 1% less in fees, you're able to draw more than 2,750 a month net. And as I touched on in the previous slide, if inheritance tax and passing wealth on is an objective for you as well, all investment portfolios, including the pension, are depleted in this example. And so there's nothing left to pass on to the next generation. So by paying 1% less in fees, your retirement income lasts longer. You might be able to afford to take a higher level of retirement income than you initially thought, and you have a nice nest egg in the pension left to pass on to your loved ones after first and foremost meeting your own needs through retirement. So fees are really important all of the time, but particularly when looking to retirement, whether that's paying lower fees now if you're younger and further away from retirement and giving your retirement pot the best chance of growing as much as possible instead of being eaten away by those higher fees, or paying lower fees now if you're in retirement or about to retire to ensure that that pot lasts for the desired number of years and the income you can take from the portfolios is the highest it could possibly be. Let's move on now to ways in which we can minimize the impact of fees on our portfolios. So I've already mentioned active versus passive investing. And so being with a wealth manager who focuses on this could save you fees whilst also not compromising on performance, as well as ensuring you've shopped around and are paying a competitive fee for the level of service you require. I'd also like to now talk through a way Netwealth helps our clients minimize their fees, aside from the competitive fee versus traditional wealth managers and lower underlying fund costs, and that's the network. So what is the network? The Netwealth network offering is unique in the UK. No other provider currently offers a single aggregate fee level across family members and friends, while still allowing each individual account holder to pursue their own financial goals. And this is why over 75% of our clients choose to be in a network to make their financial pots more efficient. So how does it work? You can invite up to 9 friends or family members, making a total of 10 people in the network. And the percentage fee clients pay is based on the combined value of the contributions, not on the individual pots. And as is typical for wealth management, the more you invest means you pay less as a percentage. So aggregating assets and benefiting from economies of scale in this way drives down your annual fees, whilst each network member can still pursue the financial goals that best suit their age and objectives. Further to the collective fee benefit, another benefit of the network is that the minimum investment amount at Netwealth, which is normally £50,000, drops to £5,000 for a network member. So let's work through an example here together, showing how the network works in practice. So on the left-hand side here, we have three individuals. Let's say they're family members. So we have a lady there looking to open an £150,000 general investment account with Netwealth, and her husband is looking to open an £80,000 pension. Individually, these clients would pay 1.05% to invest with Netwealth, as they'd be on the 0.75% fee band on an individual basis. And their son over there with the £30,000 ISA does not reach our investment minimums, and so on a standalone basis would not be eligible to open an account with Netwealth. Now, if we look at adding them together in a network, not only can their son with the £30,000 ISA now open his account and benefit from expert wealth management services due to the reduced minimums that we have for network members, all three family members of the network are going to benefit from lower collective fees, all being charged 0.9% as their total assets under management with Netwealth, when we band it together in their family network, surpasses £260,000, reducing that 0.75% fee that they were on initially to the 0.6% fee for all of them. Now, these accounts are all private and invested in line with their own objectives. The pension, for example, at risk level 6, and the ISA perhaps at risk level 2, as maybe the son saving for a house deposit. But by joining in a network together, their fees are lower. Now, if we move across to the right-hand side of the example, someone within the existing family network has a friend, they know someone who's either already a client at Netwealth or someone who would like to onboard with Netwealth and has a £750,000 pension pot. On a standalone basis, this person would also be paying 0.9%, the same amount they are currently paying separately over in the family network. But if this individual, this friend, joined the network and they all banded together, the total assets in the network is now over the next fee threshold, that 1 million mark. And because that further fee threshold is reached, that fee drops from 0.9% all in to 0.75% all in cost of investing for all members. So with 4 people in the network out of a possible 10, there's a group saving of over £1,905 in just 1 year, compared to if they all invested independently. And we know from the example I showed before just how impactful fee savings compounding over time can be for better net returns and meeting investment goals. So the Netwealth network can be a good strategy to minimize the impact of fees in your portfolio if you would like to be a Netwealth client and know some friends or family members who would also benefit. If you'd like to discuss with an advisor how the network could benefit and work for your specific situation, then we can take the time to cover this in the one-to-one sessions if you've already booked in, or if not, then please do book in and we'd be very happy to run through this with you. There should be a link sent to book in after the session. So now I'm going to pass over to Louisa, who's going to provide some insights and demos on how technology can increase transparency and drive down fees.
Perfect. Thanks, Lily. That was great to be able to see the network in action. And what I just wanted to do now was provide a bit of a demo of our online tools, really just to show how, again, they drive transparency, but also keep our cost to clients down at a minimum. So what we're looking at on the screen now is one of our demo client accounts. So it's based on real client data, but obviously not a real client. And I thought it was important for you to understand how, as a client, whenever you log into your account, the level of information and granularity that's available to you. So what we can see here is that we're looking at a client who has a total investment pot with Netwealth of just over 3.5 million. Our client information, so asset allocation performance, is always reflective as of the previous day. So the data is always updated overnight. And what we can see down here is the overall asset allocation across this client's various portfolios that he may have with us. So if I just draw your attention to the right-hand side, you can see here that this client has sterling-based portfolios, euros, and US dollar-based portfolios. So we offer these portfolios in 3 different base currencies. I'm going to focus with sterling today, but again, in the one-to-one sessions, we'd be very happy to provide further information around the other base currency offerings as well. And what we can see here is a list of the different clients' account type on the right-hand side. So he's got a general investment account, he's got a pension, an ISA, and some junior investing accounts as well. And these all may be invested at different risk levels to create a blended investment strategy based on his different time horizons, objectives, and the attitude for risk he has for each portfolio that we've opened. So if, for example, we drill down into looking at his pension portfolio, so let's take his My SIP 7 portfolio, which we can see is specifically invested at risk level 7. And that may be because this client is still in the accumulation phase of his life. He knows he won't be retiring for the next 10 or 15 years, and so can afford to take on a greater level of risk to target high levels of capital growth, but may at the point of retirement look at reducing down that risk level to provide a greater level of consistency in the portfolio value throughout that drawdown period. But what I just wanted to show here was, again, how you can view at any moment the asset allocation within a portfolio. So you can drill down into looking at the actual underlying positions each of our risk level portfolios has within them. So Lily already mentioned earlier how the team predominantly use passive funds within our portfolios. And that's really because, again, we believe they keep costs low to client whilst ensuring liquidity and also delivering on the desired exposures that we want within our portfolios. It's not to say that our portfolios aren't actively managed, because they very much are. The team will meet at the very least on a bi-weekly basis to review the investment composition of each risk level portfolio and to ensure it still provides the best risk-adjusted returns for clients at each risk level. But they'll populate these portfolios using predominantly passive funds. We do have the whole world of investment available to us, but we choose at the moment just to use these ETFs within our portfolios. And again, in the one-to-one sessions, would be very happy to kind of drill down a little bit further into this with you, to look at the individual positions, to explain why, for example, our allocation to the UK versus the US is as it is for each risk level, and why you put things like trend followers or cash within our portfolios as well. But just from an overview perspective, clients can also drill down and have a look at the sector exposure within their portfolios, as well as the regional and the currency exposures as well. So you can see here that within our risk level 7 portfolios, the team like to leave a couple of those positions unhedged to give you exposure to the US dollar, the Japanese yen, and emerging market currencies as well. So it's a really useful way of just understanding exactly how you're allocated at any given moment for no additional cost. You don't have to wait for that quarterly valuation report that you may receive from the traditional wealth managers. It's all about being kept abreast of your current plans and your asset allocations to ensure that you have consistently the right investment strategy for you. And also importantly, as Lee said, it's important to understand your investment performance at any given moment. So again, this is all updated on a daily basis. It defaults to looking at the percentage returns over the last 12 months. So we can see this here, and you can see this in the dark blue line, and we allow you to compare it to various benchmarks just to understand how you performed compared to different indices within the market. So you can see UK equities there in green and emerging market equities there in orange, but the overall portfolio of the performance of the portfolio of the last 12 months here in the dark blue. And then again, depending on how much granularity you like to go into, and of course for transparency purposes, we also enable you to view the change in portfolio value in a monetary way as well. So importantly, here on the right-hand side, you can see the change in your portfolio value in the last 12 months. So the actual amount that correlates to investment returns, and importantly, the net wealth fees that have been deducted. So we're just trying to keep really transparent on that as well. And always we're going to quote to you the fees that you've incurred, and you can always have the possibility about finding out more about your fee rates, because we think that's really important as well. You can change to have a look at different time periods, so that is available for you there. And equally, if you want to see what of the team, for example, bought and sold within my portfolio over the last 6 months, you can have a look at this here. And if you want to see specifically the fees as well, you can have a look at the monthly fees that have been deducted from your account. So Lily mentioned that we charge an annual management fee. That's actually prorated and deducted monthly from the average value of your account that month to ensure for a fair collection throughout the year. The technology not only allows you to have that level of transparency, but also the flexibility in understanding and monitoring your plans through time. So if at any point you think, okay, I'm currently invested at risk level 7 within my pension, this was a good idea whilst I was in the accumulation stage of my life, but as I'm thinking about entering retirement, I want to have a look at the impact of reducing down that risk level. So at any point you can make changes to your overall investment strategy. So it may be here that we've said your retirement age is going to be 60 and the length of retirement is 25 years. So that's modelling until the age of 85. And you want to be drawing £6,000 per month from your portfolio. You're happy with those choices, so we leave them as they are. But this is what we want to change. So we're looking at risk level 7, but we think actually maybe throughout the course of our retirement, when we're actually drawing on those income assets, we want to look at a lower risk level 4. So here we can see then a bit more about the actual flavour of that portfolio, the characteristics of it, the volatility we may expect to see throughout the investment period. And again, these are charts and this is information that an advisor can go through with you in much more detail if you do go ahead and open the account, or even if you just want to find out more in the one-to-one sessions. So let's say for the purpose of this example that I do want to update my risk level to risk level 4. I can then have a look at the impact that this will have on my overall plans here. So it's now showing me a revised investment composition now that I've chosen this lower risk level. So rather than having over 90% in equities, we're looking at a much more balanced portfolio with an equal split, broadly speaking, between equities and fixed income. And we can have a look at the impact that this will have on my financial plans. So again, something that the advisor is able to go through with you and one that we can speak to you about at any point. But if you feel actually I'm confident with my plans, you can simply click continue and we'll make those changes for you straight away and at no additional cost. So that's why I just wanted to show that it's really important to have that flexibility around your plan and to have an advisor that understands that your financial plans are a moving feast and will change through time. The advisor should always be there to support you, but you don't need to take paid for advice in order to make these changes, and you should have the autonomy of your plans if you wish to do so. The other thing I just wanted to draw your attention to with regards to being a client with Netwealth and the importance of cost efficiencies is our tax allowances and services dashboard. So at Netwealth, we think it's really important that you're utilising your tax allowances and wrappers on an annual basis going forwards each year. It can have a really significant impact on the overall wealth of you and your family, and it's not something that you should have to pay for an advisor to manage for you. It's something that is, you are entitled to and should just be done on a regular basis going forwards. So that's really why we used our technology to create this tax allowances and services dashboard to enable clients to do so without the requirement to speak to one of us, but with the ability to do so by booking a call with an advisor. So one of the things we wanted our clients to be able to do was to be able to automatically move funds from a taxable portfolio to an ISA or a junior ISA at the beginning of each tax year. So we enabled clients to instruct us to do so via this dashboard here, where they can select perhaps their drawdown account, how much they'd like to transfer, and the portfolio, the ISA portfolio they wish for it to go into. And once we've received that instruction, we'll then action it straight away. Clients, if they're nervous that they may forget to do so at the beginning of each tax year, can simply instruct us to do it on an annually recurring basis going forwards, which means we will, of course, remind you that we're going to do it at the beginning of each tax year, but we'll go ahead and do it anyway unless we receive instruction otherwise from you. So it's a really great way of ensuring that you're just utilising those allowances each year, and it's slightly a no-brainer and making sure you're being as efficient as possible. Another allowance that is really important to be aware of, albeit it seems to be decreasing ever much so each tax year, is your capital gains tax-free allowance. So this is currently set at £3,000, and if it's not used, it is lost. And so it's really important that each year you think about, okay, in my wider circumstances, have I used this allowance? Because if I haven't, then I should ask my advisor to do so for me, and I shouldn't have to pay for that service. So it's something that, again, we will do for clients free of cost, and we can do it on an automated basis at the beginning of each tax year, or I beg your pardon, at the end of each tax year, once they've been able to review their overall circumstances for that specific year. It may be that they've used up that allowance elsewhere with the sale of a property or shares in a company, and so they don't have any allowance available. But if they do, what our team here will do is they'll review all their taxable portfolios. They'll ID positions that are standing at a gain. They'll realise those gains up to their annual exemption that year by then buying a subset asset class that retains in line with the risk level profile that you've chosen originally. And then after a certain period of time, they'll buy back the original asset class. So what that effectively does is it just has the impact of rebasing those assets at a slightly higher book cost, so that when you do ultimately come to liquidate the portfolio or make a withdrawal, hopefully we're managing or mitigating the amount that would be subject to capital gains tax at that point. So it's something, again, that is your entitlement, this allowance, and so it should be used each year, and it's something that you shouldn't have to pay for as a service. So our technology allows us to provide that to our clients free of cost. Again, pension contributions are something that you should be thinking about each year. And again, it's something that you can instruct us to use from your general investment accounts or your ISAs. But equally, it may be that you have an employer contributing to these each year as well. And it's a slightly more complicated area. There are things like tapering, earnings, carry forward rules, all to be considered. And so we do actually offer a specific fixed advice package service for this at £400, a one-off fee. And I'm going to come on to it in a bit more detail in a moment, but something that, again, we like to remind clients of, because it's really is a no-brainer in terms of, if you have excess income each month, you have the available allowance to put the funds within that investment account where they can grow in a tax-free environment and then be drawn on to an element tax-free insofar as you get 25% of your pension up to your LTA tax-free, with the balance subject to income tax at your marginal rate, which actually may be a much lower marginal rate at the point of retirement than it is now when you're in full-time employment. So these are all things that we really like to keep at the forefront of clients' minds, and we're again available to talk to them about whenever they would like. And then one final point I just wanted to touch on our online demo is looking at the fees and network. So Lily's already summarized this really nicely, but I just wanted to show what it looks like in your account in practice. So, as we've already mentioned, there are management fees and then other costs of investing that you'll incur with any discretionary wealth manager. And it's really important to be aware of what those are and to ensure that you're controlling them. So we think it's really important that clients have a good understanding of what the fees they are paying at any given moment is. And so you can always access this information on your account online. Your annual management fee will be shown here. And you can see down here, we'll show your all-in cost of investing as a percentage, as well as in monetary terms as well. And you can always see a much more detailed breakdown of what specifically applies to you throughout your account each year here on the website and via your account online. So again, if clients have any questions around their specific fees, they can always ask us, but the information is readily available for you there. And here we've also got the network offering, which Lily's already touched on. So you can invite any family members, friends to join your network, and by simply sending them an invitation. And you can see that this client here is the lead network member, and they have one other client in their network. But as Lily's already mentioned, you can have up to 9 other individuals. So it's just hopefully a really useful and although albeit brief overview of our services, the technology that we have that drives transparency, enables you to visualize your plans, but also keeps costs down for clients. And just before we move on to questions, I'd just like to go back to the slides because I wanted to now cover off a bit more about kind of the advisory offering that we have and how that can help you optimize your financial plans. So the first of the services that I wanted to draw your attention to here is what we've coined the financial MOT offering. And this is available to anyone, not just for clients. And it's really an opportunity to sit down with an advisor and for them to do a thorough sense check of your plans, including a review of your overall investment strategy and your financial plans, as well as helping you to ensure that you're being as tax efficient as possible. So individuals can use our online tools, so you saw them briefly there, to create a wealth plan projection. Again, you don't need to be a client to access these tools. You can register with us at netwealth.com, and we can use the one-to-one sessions to show you exactly how to do so, following on from this session today. But you would use the plan to create your projection, and then an advisor would sit down and talk it through with you. They can suggest any adjustments that could be made to improve the plan. And you can also use the meeting as an opportunity to discuss any upcoming important actions or life events that may impact your overall plans and wealth. We charge a one-off fee for this service. On an individual basis, it's just a fixed fee of £400. But if you'd like to review your plans in the context of a partner, it can be a joint fee of £600. And really what we found is this has proved quite popular with those looking just for a sounding board to their existing plans. They don't want to go into the detail or the belly of the beast of advice, but they would just like to have an overview and an understanding and something that they can regularly review, perhaps on an annual basis going forwards and in the accumulation stage of their life. If you decide, however, that you'd like to go one step further than this, our financial advisors, so Lily, myself, and the wider advisory team, are all available to provide you with one-to-one financial planning advice. And this can be delivered on a one-off or an ongoing basis. And it's often considered quite valuable as a service for individuals who are perhaps entering a transitional period of their life, or perhaps have had a big shift in their wider circumstances. Maybe they're entering retirement and they want a recommendation for how they can best draw on their investment assets to meet their income requirement. Or perhaps they've received a large capital lump sum through an inheritance, a payout through work, which they would like advice on how to invest for their future and the future wealth of their family. And in any of these scenarios, our advice would include evidence-based recommendations, which are designed to help you make the best long-term decisions, to avoid mistakes, and to give you the confidence in your plans and your financial futures. And when considering how best to provide the service to our clients, we really wanted to ensure that we were providing clients with the flexibility around this offering, so value for money being at the forefront of our minds. So when we were doing our research and we were speaking with individuals, we found that some only required a one-off piece of advice where they may perhaps look to refresh it in 5 years' time. Others, however, wanted to take ongoing advice so that they could ensure they remained on track to achieve their goals throughout their lifetime. And perhaps those people may have had a lot more moving parts to their plans, and they wanted the reassurance that a qualified financial advisor would be regularly reviewing their setup with them. So we thought it was really important to offer both. So clients can take one-off or ongoing advice, and in either scenario, the advice would be delivered in the form of a written report that the advisor would then be able to sit down with you and review and assist you in implementing where relevant. And this slide here just shows some of the more common areas that are incorporated into advice. So clients can agree the exact scope of work with an advisor, and that will obviously impact the time it takes to prepare the advice. But often clients take value from a review of perhaps the asset allocation, income analysis, retirement and pension planning, or each advice piece, while covering similar areas, is always going to be specific to your circumstances and objectives, and can hopefully assist you in ensuring that you're structuring your investments and drawing on them as efficiently as possible. And I thought this piece of research here was really quite interesting, because often clients will ask, okay, well, should I be the one taking advice? And again, we would never advocate for individuals to take advice when they don't think they're going to benefit from it. We don't want to falsely sell you a service that you don't require. But some clients' affairs are straightforward and they have a background in finances, and so they feel confident in pursuing their own plans and would simply benefit from guidance that with advisors. So sitting down, doing that review, we act as a sounding board to your plans. But what we have seen actually, and what research does show, is that generally speaking, having a robust financial plan in place does lead to better outcomes. And so taking advice to ensure that you have done so may actually be appropriate for you. The International Longevity Centre, so the ILC, in their analysis, concluded that between 2001 and 2006, those who took financial advice were actually £48,000 better off than those that didn't. The increase in value of their wealth was actually around 2,400% greater than the initial cost of that advice piece. And the value of their pension assets were between 11% and 24% greater, and their non-pension assets also increased between 24 and 45%. Ongoing advice and follow-up advice added even more value on top of this. And the analysis showed that for those that reviewed their plans regularly or semi-regularly, was 61% better off than those that took no advice at all. So we can see here that there is a benefit to taking advice, and it's more really about ensuring that we're getting value for this advice and we're not overpaying. And so what are our advisory fees and how do they differ from our competitors? And these can all be found on our website, but I thought I'd include them here because I thought it may be of use to you, as I have spent some time talking about it. So there is a one-off advice offering as well as fixed cost packages, and these are shown on the right-hand side of the screen here. And these will always be a one-off fixed fee. So it's a pre-agreed cost. So you'll be aware of it before any work is entered into, and you'll be comfortable paying it because you would have agreed it by signing our advice agreement. And so you'll always know what it is before the service of the work is being delivered to you. Our ongoing advice fee is a percentage of the value of the investments you hold with us and is subject to a minimum of £1,000 per annum. But again, we can provide much more detail on how these apply to you specifically in our one-to-one follow-up sessions. And just to provide a bit of context on this, and because we've had a couple of questions in how our fee compared to our peer group of wealth managers, I thought this chart here shows it quite nicely. So what we're looking at here is the cost of a full Netwealth investment and advisory service versus our UK wealth management peer group. So you can see Netwealth on the left-hand side of the chart here, and this assumes an initial investment of up to £250,000, where our investment management fee, as Lily mentioned earlier, is 0.75% per annum, and you've got the other costs of investing of 0.3% per annum, and then you've got the ongoing advice service of 0.35% per annum overlaying this, which brings the all-in cost of investing to 1.4% per annum. Now, of course, if you or your network then contributed above £250,000 or even above £1 million, those fee rates or the overall fee there would drop by 15 basis points for each of those fee bands. But what's really stark to see here is that the all-in cost of investing is still at this fee rate significantly lower than our UK peer groups. So the closest competitor is the average IFA, which we can see there is around 2.14%, with the likes of Rathbones and Brewin Dolphin towards the right-hand side of the chart here being considerably far more. And as Lily's already shown you with the impact of fees, it has a significant increase on your take-home return. And so it is really important that it is something that you're mindful of. And so just finally, before we close, because I appreciate we've jumped around a bit, I wanted to provide a quick overview of the Netwealth offering, and I think this graphic here does it quite nicely. Because what we believe is that a modern wealth manager blends expert advisors with technology. I've talked quite a bit about technology today, but what I just wanted to really reiterate is that we don't believe technology or algorithms should be the ones making the investment decisions. That's where our investment team come in, or the ones providing you with financial advice. That's where our advisory team come in. So they are not there to replace the human element of what we do, and that still remains at the core of our service. They are simply there to drive transparency, to help you do things such as assess your risk capacity and make sure you're being as tax efficient as possible. But where it really does add additional value is enabling you to manage your investments and monitoring your financial plans through time. It can help you with cash flow modeling, scenario analysis, and making clearer financial decisions and understanding how your portfolio is invested or performing at any given moment. So ultimately making you much more efficient and also helping us to do so at a much lower cost. So we've covered quite a lot here, and we've talked about the importance of understanding what exactly is within your costs and charges and your investment setup. And that's something that, again, we would be happy to review with you in our one-to-one follow-ups. And we've talked about the importance of being aware that the fees can have on your overall plans, particularly in the decumulation stage of your life when you're starting to make withdrawals from your investment pots. And we've also spoken about how to minimize fees where possible by reviewing actually just what you're currently paying, whether you're getting a value from that service with the advisory part of the offering, and using things like the Netwealth network to drive down your overall costs of investing. So really, I would encourage you at the end of this to be sure to book in a call with one of our advisors so that we can review your specific circumstances in more detail and also answer any other questions you may have around our overall service and offering. But now I'm just hopefully going to ask Lily to come back and we can address any questions in the time we have remaining. So Lily, have any come through while I've been speaking?
Yeah, thanks, Lisa. So we have had a question come in. So thanks for everyone for sending those both before and during the session today. So, and obviously, if there's anything that you would like covered that we haven't covered today, then do mention them in the one-to-ones. But the question that came through was, how do I get higher returns for my investment?
Um, that's definitely an interesting question, and obviously something that will be a common theme or a common goal for all clients, really. And I think when thinking about getting a higher return from your investments, it's about understanding the elements of investing that you can't control, but being able to model for them. And by those, I mean things like market performance, inflation, longevity risk. But then what the key is that comes in here is controlling the elements of investing that you can control and actually knowing what those elements are and optimizing them. So it's things like thinking about getting invested. So time in the market rather than trying to time the market. As we've already said, it's impossible to know what's going to happen in the markets, but what we do know is that it makes sense to be invested over time. So it's thinking more carefully about understanding your time horizon and the level of risk you're able to take on. But once you've got those things clear in your mind, and those are things that we can discuss with you, it's then really important to just get invested so that you're harvesting those market returns over time. Because ultimately, we know that actually by sitting in cash versus being invested, you're just not going to be able to keep pace with inflation. So that will ultimately lead to better net returns overall. And then another key one from the investment side of things is probably just diversification. So ensuring whether it's you or your investment advisor has a robust investment framework in place. So looking at ensuring that you have different asset classes that have different drivers of return so that your portfolio is globally diversified, a multi-asset portfolio, and is not overly exposed to particular sectors or regions that will impact the overall performance of the portfolio too negatively at specific points in time. So I think those are the two really key points from an investment side of things. And then from a financial planning side of things, it's the things that we've really covered off today. So the things like utilizing your tax wrappers and allowances, which ultimately compounded over time are going to lead to a huge net take home return that you would otherwise have in a taxable portfolio, and of course minimizing fees, so ensuring that you're paying less or a sensible amount in fees versus what you may otherwise be paying. So I think those four elements there, controlling and optimizing them, are what will lead to those better net take home returns over the long term.
Thanks, Louisa. I think in terms of questions, that's all we really have time to cover today.
Um, Perfect. Well, no, thank you for that. That's great. So I think then if there are any other questions, as Lily's already kindly mentioned, please do email them to us at advice@netwealth.com, or how we've both kind of mentioned throughout the session. Please do book in for a one-to-one follow-up call where we'll be able to discuss everything or your specific circumstances in much more detail. But for now, thank you very, very much, everyone, for your time today. And we look forward to seeing as many of you as possible in these one-to-one follow-ups. So thank you and goodbye from me.